Europe. Well, let's get a bit more information on what's going on in the bond markets at the moment. Stephen Nash, Head of Strategy and Markets Developments at FIIG Securities. So, Stephen, give us your impressions to start with on the situation in Greece and how likely you believe we are to get a deal there.
Look, I think it's quite likely that a deal will be struck with regard to the voluntary arrangements with regard to Greece. However, I think the really big issue here is what happened last year with the LTRO. Without that development last year, I think we would be looking at a possible disaster scenario if a voluntary deal could not be struck. But even if we do get an involuntary deal here, it appears that that LTRO is providing enough liquidity for the European banks, and I think that's a really important thing to focus on right now.
I guess it is, Stephen, in the short term, but doesn't solve the longer-term problems for the Eurozone, and attention seems to have turned increasingly to Portugal as well. We've seen lots going on in various Portuguese markets, equity markets, bond markets, etc. But the Portuguese yields continuing to rise. We can see on the screen right now the spread is widening by the day. 14.43% is the yield on the Portuguese debt. I mean, surely attention's just turning from Greece to the next domino to fall.
Yeah, it does look a little bit like that at the moment. However, you could also have a look at what's been going on in the Spanish yields, and they've been trading a little bit over 5%. There were some quite excellent results a few weeks ago with regard to the Spanish auctions. They're actually getting to a level where some short covering might be created, I imagine, if the 10-year bond can go through 5%. So in some of the countries, peripheral countries, we're seeing some continued problems. But with the major countries like Spain and Italy, we're seeing a lot more calmness in markets. I think broadly the market was really concerned about the effects of sovereign default on the banking system. Now the ECB have come and provided that liquidity. I think that is why the market's been calm for so long now.
Stephen, just a question regarding Greece specifically. Now, I know that you're in the opinion, because I'm also in the opinion, that this will get solved. But there's a huge number of investors out there that believe that Greece will not get solved, and that Greece will actually get hived off and probably leave the euro and leave Europe, do all those things and all those disaster things. For those particular investors who believe this isn't going to be solved, how do you think the market's going to react if, in fact, Greece is left on its own?
Look, I think the really important thing from the start was the effect of a default of Greece on the banking system, and that part of it, the main part of it, I think, has been solved. So even if we get an involuntary situation here with regard to Greece, I don't think that's the main problem, and the funding of the banks is really critical to the ongoing health of the European economy. So I think that's the thing to focus on. So developments with regard to bank funding are the things to really focus on with regard to European or ongoing European developments, I think.
Well, Stephen, that brings up a really good point, is the fact that the banking industry in Europe is certainly not as solid as people believe. I think that there's a certain number of banks that are in relatively good position. You know, the HSBC, some of the French banks are doing fine, but generally speaking, the banking industry is pretty soft. Yeah. So if they're unable to get additional funding, which is highly likely that they are unable, and we see more bank failures within Europe, what kind of effect is that going to have on the bond market globally?
Yeah. Look, I think the ECB's been in emergency mode for quite a while now, and I think they're quite used to handling difficult banking situations, so I think that's going to be an ongoing story for the ECB. You know, if anything, what we're finding in the Australian market is we've been finding it hard to find offers in French bank bonds at the moment. A few weeks ago, it was hard to find bids in those. So it's telling you something, and I think what it's telling you is that confidence is starting to re-emerge in some of the major French bank names and other names in Europe, and I think that's critical. And I don't think it's been really emphasised enough in commentary so far.
Stephen, we also have the Fed meeting, which will end tomorrow. A new communication strategy, or a tweaked communication strategy, I suppose we should call it. Lots of speculation about pushing out the date of potential future rate rises even further. What's your expectation there?
Yep. Look, I think the market has been looking at this for at least a month and has been expecting that this is going to happen. So what's been going on recently is we've seen, since the last easing by the RBA here, equity markets have rallied quite a bit to around the 5% level. 10-year bonds, our 10-year bonds have actually rallied a bit. Bonds have held in very well despite this recent rally, and I think what the market is looking for is that pushing out of the tightening time to 2014-15. The market's also, I think, looking for some sort of intervention in the housing market. Bernanke had a report to the Congress which pointed out that they think that the housing market is a real impediment to growth. I think the administration is really concerned about housing as well, so there may be something in the State of the Union on housing as well. I think the market is looking for some sort of QE in one way or another as well. So that's what the market's been looking for and why yields have held in so well.
OK, Stephen, thanks very much for that. Appreciate your time today. Stephen Nash, Head of Strategy and Market Development, FIIG Securities.